Thank you very much, David, for this presentation. So it's time now for Sabine to start the Q&A with you, David. So on to you, Sabine.
Thank you, Nicholas, and thank you, David, for these interesting insights. To start with, I would like to go back to the question of data quality, a question that was, by the way, also raised by one participant from the audience.
I just got the
You
feed now,
showed
so
us
it's working.
figures
I can
on
record now.
the
Just a second, let
reporting
Sabine start.
coverage for different factors, and for some factors it is quite good, for some countries it's quite good, for other countries it's rather bleak. Can you explain to us again how you actually deal with missing data? Do you give companies or even countries a zero score where you do not find information, or how do you deal with it?
Great, thank you, Celine. So within our ESG model, we see that as a major risk when a company is not providing the data. And so when we have those performance indicators, so when we're looking at, for example, fatality rates, we're normalizing fatality rates by staff numbers. If a company isn't providing its fatality levels, and it's in an industry which has big health and safety issues, say construction, then we score it as if it was bottom quartile. So all of our performance indicators, we score by doing percentile rankings, putting them into top quartile, second quartile, third or fourth. If they're not disclosing, we put them into the fourth quartile. So underweight them. Now, for most markets, you've got, as we saw earlier, quite a lot. There's pretty good reporting in it, and it's improving. But there are some markets, take China as an example, where we only have 7% of these data points being reported, and so it makes it very challenging. It means for example, for our FTSE for Good emerging markets index, we have very, very low representation of Chinese companies. I think that's also representative of some of the ESG risks, that there are very significant and unknown ESG risks in that market.
So in other words, investors taking ESG factors into account will by nature have an underweight in developing markets, especially in Asia, and maybe also in the US, as your table shows regarding the coverage of data. Is that true?
Well, I think that's right. I mean, the thing is, that's basically but it's also then about how you want to approach that. So for some investors, they won't want to change their country or sector allocations, and so then in which case it's more than that would then be built into whether it's an active fund strategy or whether it's an index fund. You can then build that in. But then what it would mean is, so if it's an ESG index fund where you're then wanting to try and maintain regional weights relative to the underlying benchmark, there's one of two implications of that. Either you then include some of the companies which may be more, you use a lower sustainability threshold essentially for countries, the markets where disclosure or performance is lower, or you have to increase the weight of those stocks which are disclosing or performing well from those markets. So there's different techniques to apply if you've got a reasonable universe to begin with. As I said, the market that really stands out here is China. As you've got such low levels of disclosure that it makes that very difficult to do.
Sabine? The next question?
Oh, sorry. Yes, here I'm back. Thank you for these insights. We know all investors usually care about performance, and I'm sure it's your objective to also provide them with a good performance of your indices. What kind of research did you do on the influence of ESG criteria on the financial performance of stocks, and what kind of correlations did you find?
I guess this is the $1 trillion question. What you have to do, it's a bit like saying, does smart beta outperform, or does the factor in it? There's a huge range of different subcomponents to it. So you then have to really kind of drill into particular pieces. I guess if you take the foregone, so you take the FTSE for Goods, Global Index, or all the FTSE for Good series, I think most of those have been outperforming over the last 5-10 years, but then there's been other significant periods where they haven't. I think overall, the performance is pretty similar. You always need to kind of drill into some of the underlying components to take a view and to be able to analyse it. You've also got limited data history here. So the research team at FTSE Russell actually often don't like me using the term factor when referring to ESG data, because for them, to be a factor, you have to have 30, 40 years worth of data history. In sustainability or ESG data, you don't tend to have more than 5 or so years worth of history, because as you go back, there's less and less data available, and the methodologies and the models change. So these questions are quite hard to do. The analysis we've done, when you do things on a very large aggregated basis, typically show you're not really getting, there's no statistically significant out or underperformance at an overall level, but what there does seem to be is some very significant correlation with volatility, and it does appear to be that companies which have higher ESG ratings appear less volatile than companies with low ESG ratings. But that seems to hold equally across the E, the S, and the G.
Thank you for this. And now I would like to shift to the whole question of reporting that you also outlined. First of all, we know that companies are already facing a lot of reporting requirements. If they are a signatory to PRA, maybe to the UN Global Compact, they will have to report for these frameworks. Maybe they also report according to GRI. You mentioned the initiative of LSE in giving guidance on reporting. Do you also see a tendency for convergence in these reporting standards? Do these different standards actually cooperate to make it easier on the long term for companies to report the kind of material data you wish?
Yeah, it's absolutely critical. So this is a huge issue. It's one of the reasons why we chaired the Central Stock Exchange guidance, as we thought what the dangers if each different exchange comes up with very different guidance to companies that actually creates more of a nightmare both for companies and for investors. So we want different exchanges to work on a common basis, which is why we then developed kind of a model guidance that each exchange could then try and take and adapt for their markets. What we did with our guidance was we drew from, in terms of, a lot of it was focused on principles. There is then a number of positive data points that we recommended companies to report against, and we drew those from established existing international standards, which FTSE Russell has also done through the development of data points as well. What we don't want to try and do is reinvent the wheel. We want to identify what are the most credible international standards and use and adopt those and try and drive much more consistency here. So you're right, this is a big issue, and I think it's something which we all and everybody on the call needs to try and help work towards. We'll all be playing roles within different associations, different organisations, and what we need to do is try and encourage different standard setting initiatives to collaborate and to develop and draw, to try and work towards harmonisation, so we don't have a myriad of similar but slightly different data points that are being requested from companies.
Now we all know that TCFD also came up with a report with recommendations on climate reporting, and according to my opinion, they brought in yet a new layer by asking for scenario data. What do you make of their recommendations? And do you think the way financial analysts work, they are, or investors work, they are in a position to use scenario data?
Okay, good. So, also, I think it's fantastic that the Financial Stability Board has stepped up to the plate here, and the task force on climate-related financial disclosure has done some great work. And we've also, as I'm sure many people on the call have done, we've fed into the consultation responses at both stages. And this is a real opportunity with the weight of the FSB behind it to help establish global standards here. There's a lot more work that obviously needs to flow from it. This is, even when their final report gets published, there's a lot more work to be done in terms of then making taking through a lot of those recommendations and really being very precise about what the reporting should be sector by sector. It's really important. It's really important work. I mean, the scenario analysis stuff is all very new. And I get the take-up currently the take-up of that kind of approach is almost non-existent. So it'd be really interesting to see how that gets picked up, how that gets used, and how that starts to influence. But certainly what we're seeing, and TCFD links into this, is a movement from a requirement on listed companies to report through to really the whole of the investment chain, and looking at asset owners, asset managers, banks, and other intermediaries that start to try and report to and what their exposure is. And looking at what's been happening in France with Article 173 and its reporting, which I think struck a very nice balance between setting some kind of high-level priorities in terms of the areas to disclose on, in terms of energy transition, in terms of carbon and climate, and also in terms of ESG more broadly, but not being too prescriptive about how to report, and then really leaving it to the market to start to try and innovate. I think there's a danger if you try and get there's also a danger if you try and get too prescriptive too soon, but that can then kind of kill off that innovation. So that felt like a great, it's a very clever regulatory approach to encourage better reporting right the way through the chain. And also what we'll now see, I think, at a European level, and I'm part of this, which is there's been an expert group that's been set up by the European Commission to provide advice on how to make European capital markets more sustainable, how we can encourage the flow of capital towards more sustainable assets, and looking at what the sort of barriers are there, and how to overcome those, and that will deliver its interim guidance in the summer, interim reports in the summer, and then its final report will be in January next year.
To bring in yet another new framework, I would like to briefly touch on the SDGs. We've seen quite some innovative reporting on SDGs from financial service providers. You mentioned before that the innovation shouldn't be cut off yet. What do you make of the SDGs as a new framework to measure sustainability in the investment field? Has it, for example, influenced your systems already, your rating systems, or will it do so in the future?
Yeah, they're great questions. So I suppose they represent a very clear, globally agreed framework, and so they're quite a useful basis, which I think for a number of investors, a number of asset owners, that provides a useful framework to then start trying to think about ESG. So yes, we do see them as important. So what we've been doing is looking at the SDGs, looking at the data that we currently collect, and doing a kind of a mapping exercise, looking at how does this data relate to the SDGs, so we can start to be able to enable those that use our data to be able to see how the data sets relate across each of the sustainable development goals. But also that, also highlighting some potential gaps too. I suppose there's also a discussion about about how do you measure the impact and which often is then linked to product and revenue. So particularly linked to a lot of the green SDG or environmental related SDGs, there's quite a link across not only the ESG model but also to the green revenues model. But that's you'll see more from us starting to come out over the months ahead around that.
Thank you for this. And now two more questions from the audience. One about main barriers. Where do you see the biggest hurdle preventing ESG actually to becoming even more mainstream? I mean, I was surprised to hear that you found out in your survey that 42, even 60% want to include ESG in non-beta strategies, but yet we see that it hasn't really arrived in the mainstream. How do you think existing hurdles could overcome, and who plays the biggest role there?
That would be good.
I would challenge that. I think it hasn't yet really become mainstream. I'd say, certainly from our experience, building a benchmark.
I don't have a question.
Very large.
Hey, if you have a question, you can type it here. I don't even understand what they're talking about. I don't know what to ask them, honestly. If you have a question, type it.
You are the smartest guy.
No, I'm not.
So I think though when you then look at who's doing this, it tends to be, I mean, particularly looking at it from an asset owner lens, this is really it's the largest, the most sophisticated asset owners which are going first. Historically, it's also been it's been led by the public pension funds. But what we're starting to see is the corporate pension funds. So that's an interesting thing with HSBC pension funds. They took this approach. And again, this wasn't for some kind of ethical option. This was about their core default funds. All UK HSBC staff, unless they're selected out of it, will now have the kind of balanced factor index, Elgin's future wealth fund, as their default option for their equities. So we're also starting, and we're having discussions now, or more discussions moving forward with other corporate pension schemes too, that are wanting to take a similar approach. So it is happening. How can it happen even faster? Maybe I can interpret it that way. And this is one of the things also which this European group's been looking at. Two things I've been raising in particular as part of that group is saying the role of trustees and the role of consultants is critical. What helped with HSBC pension funds, one of the things which helped contribute was the fact that on their trustee board was somebody who also had a senior role in terms of the sustainability part of their business, in terms of managing HSBC's internal sustainability. And so it was able to bring some of our thinking to the trustees, and they were able to benefit from that. So I think one thing which would make a huge difference would be if corporate pension schemes made sure that one of their trustees had got good ESG or sustainability knowledge and understanding. That would really, I think, help trustees get their heads around. Because this is complicated. It's very different to a lot of the other issues that they're discussing and thinking about. So that can make a difference. And I think from investment consultants, they're pockets of great work, clearly. But equally, when you look at most individual investment consultants, the great work that's being done by their responsible investment colleagues isn't necessarily always always getting across to a lot of the field staff. And so there is, I think, still a real need for investment consultants. But a big, and actually a really significant thing just this week, this was in the UK, there was advice from the Institute of Actuaries in the UK, which was a recommendation to actuaries to start to pay attention to climate risk. So we're seeing major changes here. I wouldn't say that this is now becoming a core part of the market, but there's still a need really to try and accelerate this so it starts to hit particularly a lot of the corporate pension schemes, and also starts to go to not just the very biggest ones, but starts to make it a bit easier for some of those mid-sized asset owners as well.
That's a very interesting idea, to find motivated trustees and approach them and maybe help them in bringing up the topic in their board meetings. So maybe even a topic that could be covered in engagement. Maybe a last question. What kind of ESG strategies are the ones that where you see great client interest from the side of institutional clients? Is it more the modern approaches that you mentioned, the smart beta approaches, or where do you see the biggest interest?
So if I look at what are the sustainability parameters where there's most interest in bringing it into a smart sustainability index framework, what I see is at least 50% of the things we're building different climate change and climate related components. Is very important. It's not exclusive, so there are times when we're building in the ESG rating, or sometimes there will be particular themes. There's one part of the moment there was an interest in how we bring in the human capital and labour standards theme, and using that as one of the parameters to tilt with. So although there is there is interest across all of the different ESG themes, it's very clear that the biggest area of interest is around climate. But there is also a big desire to move away from a simplistic approach on just carbon emissions to also wanting to think about other key climate parameters, not particularly reserves, but also the exposure to green economy sectors and trying to capture that industrial transition as we see new green sectors rise and emerge, and how that starts to shift the shape of the global economy.
Thank you for this, David. I think we've pretty much come to an end. Also, if I look at the questions from the audience, we've touched on really pretty much all of them. So, Nick, if I may pass back to Nicholas.
Thank you very much, Sabina, and thank you very much, David, for these insights on the trends we've seen happening in ESG investing and the emergence of smart sustainability indices as well. We've been talking a lot about this in this session, and actually I confirm that there's a lot of demand from clients for these thematics. I would also like to thank, of course, Imaratem from Partners for Sustainability again for hosting this webinar with us today. There is a large number of questions that unfortunately we haven't had the time to answer, but I would invite all the attendees to reach out to us, FTSE Russell, at info@ftserussell.com. If you have any question, of course, we'll follow up, and if you have any questions to our partners today, Swiss Sustainable Finance and Partners for Sustainability, feel free to reach out to them directly as well, of course. In closing, again, thanks very much for all the listeners, all the attendees today. And one last thing I'd like to ask you before you exit is provide a quick rating of this webinar so we can gauge the overall audience satisfaction. If you could simply click on the rate this button at the top of the screen, that would be fantastic. Thank you very much and goodbye.
This live webcast has now finished. Thank you for taking part. A recorded version of this webcast